Hey, I'm Joey. Welcome to the Exchange. For the first episode, I want to really get started on these past 3 months. We've had a lot of volatility and a lot of fear going out there in the market, and then I think we have had media to sources, both bullish and bearish sides, been all over the place, and it's created a lot of volatility looking back. But really, since November, we've had this Omicron variant, which has been a pretty dangerous variant out there. But I mean, we've been fortunate; it's not as impactful. It's been very contagious, but not as impactful as it could have been otherwise. But for the markets, though, I mean, they had a hard time pricing that kind of variant in going forward. But we still had a strong holiday shopping season. It was roughly, I believe, 14% year over 2019 or versus 2019 sales. So it was a very strong holiday season, very strong Q4 close out the year. Pretty strong in the market too overall. I mean, the numbers actually are looking pretty good. There's just this forward-looking fear of, hey, are we at the cliff? Is this 2008? Is this the dot-com boom? Are we about to head over the edge potentially to like a whole new economic cycle potentially? That's what I want to talk about this too, because I feel like there's a lot of fear out there, a lot of information out there. It's pretty accurate, but there's sometimes a twist or sometimes there are biases in there that are definitely very dangerous looking forward though too. But really, first things first, let's look at the S&P 500 overall. This is the full length from let's see here right here 1950s all the way to present day time period. And it pretty much is. Obviously, you see the volatility there. You see some big spikes or some big drops, and it's very, very normal. It happens. So if the question is, hey, if I'm a long-term investor, do I buy stocks or do I buy bonds or do I even invest at all right now, or I take it all in cash? The answer is, I mean, you just invest over the long term, long-minded investor. And we're talking here at 15, 20, 25 years. Like, you're talking trying to invest for retirement. Like, there's really no bad time. Obviously, there's timing that could be worse or better than others, but the timing overall is totally fine going forward. If you're a long-term investor. Now, obviously, if you're trading, and look at this fact that trading is in a year or less holding time period, there's obviously, this could be a bad time to buy in. It could be a good time to buy in, depending on how you're buying in. Really, what we've seen in the past, few months or few weeks is really this flight of capital from these small tech, SPACs, growth stocks, to these large mega cap tech companies, which are almost the same as like cash. They're basically almost like cash holding companies because they have strong financial earnings, strong financial backgrounds. If they're going to fall, they're going to be the last to fall in a long wave of dominoes of potential companies going forward. But looking right here, this is the log scale of the S&P 500 going forward, and really, you've seen here. It's even this latest dip is not that big of a dip in the grand scheme of things. If you take away the log cycle, you see right now we're still up near these massive, massive peaks. Now, your first thought is probably like, hey, we are at a huge inflection point. We're at this huge growth of this curve. You have to remember in the past 10 years. The amount of transformation we've had digitally, work from home, Microsoft Teams, we've had Zoom come out. Productivity has been sky high in the past, even the past 2 years or so. So, like, that's why this cycle of economic activity is so different than even the previous 10 years. That's why it's hard to gauge. I mean, you look at like, hey, the growth in Nasdaq, the growth of S&P 500 in the past 10 years, and you've seen this massive, massive, bull market going forward, which has been fantastic for many investors. You really invested in anything at all. So, I mean, it's been fantastic for them going forward. But so the question is, if you want to invest right now, if you want to invest, long-term minded, absolutely go for it. There's no real issues there if you're long-minded focus. The only caveats to that would be definitely invest in companies that have cash to survive a credit crunch or a recessionary potential crunch. So the idea is hey, they can survive that 2 or 3 years potentially on their cash or the credit market if they absolutely have to raise credit. Otherwise, you can get pinched pretty badly too if they have to also raise distressed debt or potentially have an equity offering in a distressed market, which is probably not going to be a ideal scenario for any investor going forward. But we also saw Jerome Powell talk last week. I mean, his comments were pretty not bad, but I think there's definitely a bearishness in the market seeing right now. This idea of what he priced in was saying he's like a 0.25% or 25 basis point increase in March, potentially in March. Over the federal funds rate, which is not that high. We're currently on a 0 to 0.25% current target rate, which a 0.25% interest rate is not that much. It's not much of a change, though, but the trajectory, the future cash flows of those growth rates are definitely going to be a challenge potentially. I really see the max here as probably about a 2% federal funds rate. It's kind of the ceiling where it's going to be, because they really see long-term inflation as going to be roughly a 2% target, which I think they're going to get there pretty fast, actually, too, even though right now we have a 7% inflation curve, or 7% inflation, year over year, which is a very scary number. But you remember too, right now we have supply chain issues, labor shortages. There's all these functionalities that are coming in the market we're trying to balance out. And it will balance out pretty quickly overall too. So I think I'm gonna put other videos in that too of the labor and kind of the supply chain headwinds that we face that could actually drop down inflation and make inflation less scary of the numbers, less scary of a print we're seeing, at least on a year-over-year basis going forward. We're still continuing with the actual $20 billion per month of the Treasury security purchases. The same thing with the MBS products, $10 million per month. So we still have $30 billion of actual liquidity additions coming in, in the February-March timeframe. So that's good for the market overall too, but it's going to stop though. The question is, once it stops, what's going to happen to the market going forward, and how's that going to affect people's equity portfolios? Second thing here, which is actually pretty scary for the market, the idea of tapering the Fed balance sheet. So if you're not familiar with the Fed balance sheet, it's an $8.9 trillion basically holding balance sheet that has a mixture of mortgage-backed securities, treasuries, other assets on there going forward. So the idea of a tapering a Fed balance sheet is actually pretty scary overall. Yeah, and this chart right here shows the growth curve of the Fed balance sheet right here. So we see right here in the top right, that's present day, roughly $8.9 trillion, which is a massive amount. It's roughly about 35% of GDP, which the Fed goal is really get that in the 20% kind of range, 2025 somewhere in there, just because it's a more stable overall exposure to the market. But just really, to look at it this way, it's almost like a personal portfolio. This is a long, basically, asset risk allocation to the market itself, to the U.S. market more specifically going forward. So really, if we see right here a taper down to this $5-6 trillion range, which the hard part though, we look at over since 2008, you really see here. I mean, we tapered a little bit towards 2018 and in 2019, and it really was not. It's not much though. So we don't taper fast. So too, because look at the taper overall. What a taper is basically a taking away of buying power, taking away of liquidity from the market right there overall. So tapering too fast, you actually can cause a recession and cause the markets to either stall or actually turn into a recessionary environment. That's where you really see these bearishness fears coming from. It's not malintent, it's not bad, it is what it is. It's the overall trends of flows, and especially these negative flows coming out of the market or not there in the first place. You're going to see some downside risk in equities across the board, both from small stocks to the mega cap big tech stocks going forward. But the hard part here is with a Fed taper, a Fed funds rate increase. The hard part is, this is what Jerome Powell actually stressed a lot last week, was he wants to raise the rate, and then afterwards he wants to potentially reduce off the balance sheet, seeing how the actual effects go. Simultaneously, it doesn't want to do it together because we know how a federal funds rate increase will affect the market. It's pretty well priced in, kind of how fast we're going to raise, how many raises we're going to do going forward. But a balance sheet taper, especially if they aggressively taper, is going to be a lot more dangerous for the market. So the pricing there could get a lot more volatile going forward. But you go to the federalreserve.gov, you actually pull up the actual principles for the balance sheet, reduction overall too. So again, the number one bullet here is their target mechanism, target tool they're going to use is the federal funds rate. They don't want to simultaneously use the federal funds rate with the actual balance sheet reduction simultaneously, because it's hard to tell how much to go to, and how much is too far potentially too. Because if you do both at the same time, you could have a huge backlash and a huge basically downward spike across the equity markets, and potentially the bond markets get a lot more volatile. Again, timing and pace going forward is going to be a lot more up in the air. It's going to be data driven too. So if the market would potentially hate this, or if there's a huge, not crash, but a huge, downside shock, they will either slow it down or potentially pause it too. What short term is better for the market, long term it's worse for the U.S. economy. But that's kind of the game they're playing here. They're basically trying to find this balancing act too, which is very, very challenging for anybody. It's not Jerome Powell's fault. It's just the nature of the balance sheet size that it is, and the nature of the economic growth cycle we're in right now, or how it is volatile overall. But yeah, overall, we'll see what happens. It's going to be real curious to see. I think the federal funds rate, there's potential chances anywhere from 2 to potentially 6 raises this year, if not more. But I really think, when you look at Jerome Powell's comments, he's really buying time. He's stalling for time. He wants to see the data. Like, he does not want to raise rates aggressively because he knows, he's a former banker. He knows, hey, this will be a downside risk to the market. This can cause massive pain for the market, especially your small caps, your SPACs, et cetera, your growth equity stocks. They can get absolutely killed because those future cash flows they're going to receive are diluted basically by a higher Fed or higher interest rate going forward that they discount against. But I think he's going to know. I think he's looking for that strong data potentially in the February or March inflation reports to see, hey, inflation's either stalled or it's topped out, or potentially it's actually decreasing. And I'm actually going to dive into that later. But yeah, definitely let me know if you want to talk on some of these topics. I'm definitely going to dive into some supply chain issues. auto issues, potentially the auto inventory overall market is kind of a mess right now. Retail market, how we're actually seeing those trends shift, inflationary pressures, also even like retail consumers seeing how they're actually, the money, the credit they have, is it actually maxed out right now? Is there still more to go? Are we at the top of the credit cycle overall for consumers? But if you have any ideas, let me know. Definitely subscribe. Launch the channel off this week. So hey, welcome to the channel and thanks again.